Hey guys, Steven again, CFP, Certified Financial Planner in Charlotte, North Carolina. And I wanted to talk you through what combining multiple years of charitable giving into 1 year looks like and how it benefits you or could benefit you. We're going to talk through, is it worth it, how to do it, and what are best and worst use case scenarios for it. So is it worth it? It really depends on how much you're currently deducting per year. So if you are to donate $10,000 and that's your only deduction or deductible expense for the year, and you're married filing jointly, and the standard deduction is $32,200, then you don't get any tax benefit for that charitable gift, okay? That $10,000, because it's not greater than $32,200, if you choose one, and because the standard deduction's higher, it's better for you to choose that one. The only time you really get to benefit from charitable giving from a tax perspective is when that amount becomes greater than the standard deduction. So if you have a couple different things adding up, maybe you have some mortgage interest or student loan deduction and the interest paid in that, then you can combine those and add the charitable contributions on top in order to make it deductible. And so I have an Excel spreadsheet here, and we will talk through these examples because I know how much you guys love examples. So basically, let's say that you're going to give over the next 5 years, and you're going to give $12,000 per year, and you normally have deductions of $15,000 per year if we combine your mortgage interest plus anything else you have. So right now, you have $27,000 of total itemized deductions, but the standard deduction is $32,200. So none of these improve your tax picture at all. You could have $0 of itemized deductions, and you would pay the same in taxes. And then the other option over here is if we clump all 5 years of this $12,000 into 1 year. And what this does to your tax picture, and again, I understand you need a lot of liquidity for it, but if you can make it work, then it could save you around $7,000, $8,000 in taxes, assuming your tax rate is 24%. You live in North Carolina at a 4% tax rate, it's 28% total rate. The total excess savings would be $27,800, and it would save you $7,784 in taxes. Now, how this works is you just front load all your deductions, right? So this year, your total deductions are $75,000. And so because of that, it's higher than the standard deduction. So you receive all that deduction in 1 year. The rest of the years, the gap here, this is still the greater option, $32,200. So you still get $32,200 here. No different than up here. But this first year just gets all of it. And so your total deductions over those 5 years is this $27,800 number. It's that much higher over those 5 years, which is where the savings comes from. Now, how do you do this? One of the best ways to front load those is through what's called a donor advised fund. There's a company called Daffy that I like, DFFY, and you can open a donor advised fund over there, and you could donate just cash, or you could increase your deductions or savings even more if you had appreciated stock that you could donate. So let's say you had some NVIDIA stock that grew a lot. And so you can take that and you could say, okay, instead of paying 15 or 20% capital gains taxes on this stock, I can donate it in kind directly into my family donor advised fund. Let's say it's 50 grand that goes over there. So we'll use the example, $60,000 that goes to your donor advised fund. Once it's in the donor advised fund, you can sell it, pay zero taxes because it's now out of your control. It has now kind of been donated. You receive that full deduction for that year. Once that transition has happened, that transfer's happened. And you could invest it in T-bills. You can invest it in your 60-40 split portfolio. You can invest it fairly riskily if you wanted to, or you can just hold it in cash and then donate it out to charities over time. So that is a tool that I really like to use for a lot of my clients, and it can save a lot of money. Best case scenario, somebody has a really high income year, okay? They sold a business, they just crushed sales quota, it's probably not gonna happen again next year, cool. Instead of just paying taxes at 32 or 35% tax bracket or 37, depending on how income that year is, we could make our one large donation this year. So it kind of lines up with this big cash flow influx. And then after that, going forward, we can just kind of donate out over time from our donor advised fund. Worst case scenario year is if you're so far below the standard deduction that stacking up all your charitable contributions just barely breaks you over the standard deduction limit. And let's say you're 5 years combined and you don't have any of the deductions, adds up to $35,000. The illiquidity may not be worth the minor increase over the standard deduction you're getting there. So I hope that makes sense. If you have any questions, let me know. I wrote a blog on kind of best ways to charitably give, and I'll link that below. But I hope you found that helpful, and have a great week.